Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Here is your starting lineup for the 3 in 10 podcast for Friday, September 26th, recorded at 12 p.m. Eastern Daylight Time. Our 3 things this week. Number 1, Capital Creek held its 5th annual investor conference. We have some takeaways that center on the AI boom becoming more speculative, but still having further to run. Number 2, is the U.S. housing market finally starting to wake up? We have some data to support that notion. And number 3, the most important inflation data of the month, Core PCE, prints right on the screws, but we get under the hood to see what's really going on in inflation under the surface. So back to number 1. We had a great conference with about 350 attendees, some fantastic speakers that really caused us to think a lot about the CapEx boom that's going on. And the AI CapEx boom is getting pretty wild. Some of the numbers that are being thrown out there by OpenAI, by Oracle, by Meta, we learned that it's probably going to take about $6 trillion in financing to build this out. So the boom is getting wild. We think it has further to run. And in baseball terms, we call it middle innings, 4th, 5th, 6th inning of the ball game. So not the beginning anymore, but not the end. We learned about a whole new area of the market that we had not thought about called growth infrastructure. There's going to be so much infrastructure built that it's going to be a growth industry for a while. It's going to require capital innovation. And where do we see capital innovation? We see it coming from private credit. These are the smartest, best, most flexible lenders in the world. And they are going to be absolutely necessary in the free world here to support and finance this incredible CapEx boom that is going on. So we are now in what is called a power-first world. So without power, we can't build these data centers. Without water, we can't build these data centers. So first of all, to build them, you've got to find a source of power. And it's going to take us a while to build out the power infrastructure and the grid to support all of this. So power first, data center second. And it occurred to us that data center jobs may be the new blue-collar jobs of the future. We found out we're going to need almost 150,000 electricians to pull this off in the United States alone. Wow, those are going to be some really good, stable, high-paying jobs for the tradesmen. And that's what this country's really been lacking for the last 30 or 40 years, support for this middle group that needs good jobs and income. And the unions can actually support these people and train them and get them up to speed fast. So maybe some new life for the unions. Another interesting thing I took away from the conference was that the Mag 7, the Magnificent 7, have been financing a lot of this build out, almost all of it out of free cash flow. And they've had the cash flow to do it. But now the numbers are becoming so big that it probably can't be financed out of cash flow alone. And some of these 7 companies will actually go cash flow negative. So we've been able to justify the valuations because they're not taking on much more debt. They're generating prodigious cash flow. They're spending out of that cash flow. But if you start to take on more debt, the game gets a little more dangerous. And I did a search and looked through some of the balance sheets. They're not cash flow negative yet. But just with some of these numbers that are being thrown out there, they're clearly going to have to need to go into cash flow negative territory for a while. So a more dangerous game. And one of our speakers said the probability of an AI CapEx related reset or drawdown coming is practically 100%. It's just a matter of when. But I left the conference thinking, yes, it is going to happen at some point, but it's not here yet. I don't think it's really even close yet. I think we're more in what I would describe as 1996 for the internet boom rather than 1999 of the internet boom. So now on to housing. The astounding new home sales in the month of August were really interesting to me. And it made me wonder, are we on the cusp of housing awakening and becoming a positive contributor to GDP after being really moribund for a long time? I've noticed that mortgage rates have come down a lot, and we're starting to see some firming demand for homes. The 30-year mortgage rate has fallen from 7.4% in January to 6.3% today. That's 110 basis points and a 15% decline in the overall rate of interest. So, as we say almost every week, consumers have jobs. Households have real incomes now, and households are being formed. Life happens. A lot of people have put things off for 3 to 5 years now. There's a lot of pent-up demand for housing, and I think this market may be waking up. The Fed is going to continue to cut rates. And mortgage spreads to treasuries, they got so wide, they're now coming in sharply. And I just think if housing starts to kick in, the U.S. economy can surprise to the upside at a point when very few people are expecting that. And then you think about the second order effects, the demand for goods like cars, refrigerators, white goods, services, lawn care. Housing drives a tremendous amount of ancillary services and goods. So goods inflation could start to tick up more as well. We didn't see that in the Core PCE data this month, but price increases may begin to get passed through once corporations feel like things have settled down and the level of uncertainty comes down. So that leads us into number 3, Core PCE for August, just printed right on the screws at 0.0227. And under the hood, it was all services. Again, every month I see this. Services were actually 0.0238. So they were more than 100% of the gains because we had durables tick down a little bit into negative territory and non-durables also deflated a touch. Service inflation continues to prove harder to tame. Services industries, for the sake of the Core PCE, are leisure, hospitality, education, housing, healthcare, and transportation. All of these are people businesses. Services are about people and labor. There are lots of inefficiencies in services, and it's harder for productivity gains to flow through and shine through. The lack of immigration makes it harder to find workers for these industries. So no wonder that services inflation remains sticky. This key piece of data is unlikely to change the narrative at the Fed. It came in line. So I don't think it changes the narrative at all. The Fed is going to cut rates by another 25 basis points on October 29th. I have pretty high confidence in that we are in a new rate cutting cycle. It's not going to be one and done for a while. And I think that the markets and the Fed can live with Core PCE at 2.9, let's call it 3%. I went back and looked at the long-term average of Core PCE since 1959 when the measure came into existence. It has averaged 3.25% all the way back to 59. So we're really in a very normal rate of inflation right now at 2.9%. We believe Core PCE will be in a 2 to 4% range for the next 3 to 5 years, with 3% remaining the central tendency. Markets and the American economy can probably continue to prosper under these current circumstances. The Fed, of course, is forecasting 2% inflation by 2028. They have to forecast that because that's their target. But they keep pushing this forecast out year after missing their target for 5 consecutive years. So we doubt their forecast as they keep pushing it out. Interestingly, this morning, the University of Michigan survey for the next 5 to 10 years came in with inflation expectations at 3.7%. We think that's probably a better forecast than the Fed. So we'll take the wisdom of crowds over the wisdom of the Fed every time. So do the work, endure the pain of gain, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.